Hello, RIT Tigers, and welcome to today's Tiger webinar. I'm Bill Sackman from RIT's Division of University Advancement, and I'm your moderator for this event. We are happy to have you join us today and hope that you and your entire Tiger family are well. We want you to know that RIT's Office of Alumni Relations is available to help all alumni with a variety of needs and networking and career assistance through our current work and life realities. If you are not already connected to the RIT Alumni Association social media channels, including Facebook, LinkedIn, and Twitter, we encourage you to follow these accounts. You will find up-to-date communications and opportunities to connect to other Tiger alumni in your region and in your industry through Alumni Association social media. Those links are found in the chat box. The chat box can be opened by clicking on the chat tab on the right of your webinar window. Many in our RIT family have asked how they can help our students and the university as we respond to the pandemic. We are incredibly grateful for those offers. There are two ways you can help. First, our new graduates and current students are seeking positions for full-time careers and co-ops, respectively. Many of those positions have been delayed or canceled entirely. If your company is hiring or would consider adding a co-op post, please contact Chris Steeler at RIT's Career Services Office and allow her to post that position in our systems. In addition, there is an unprecedented need for financial aid scholarships for this semester and coming years. These scholarships help both new and continuing Tiger students. If you are able, please make a gift at the link in the chat box. Thank you. Just a few housekeeping points. We want to ensure that everyone is familiar with the presentation tools. If you are joining from a remote location and are currently signed in to your company's VPN, we encourage you to close that channel during the webinar to increase the quality of the transmission. The webinar platform is secure without VPN. All attendees have joined in mute mode. However, your questions can be entered in the chat box at any time throughout the discussion. We will make every effort to address all your comments and questions throughout the webinar. You are joining this event using broadcast audio. If you wish to dial in by phone, dial-in information is provided in the chat box. Live captioning is also being provided, and you can find the link to access that in the chat box as well. This webinar will be recorded and made available, complete with captions, in approximately 1 week following today's event. All participants will receive an email with the link to the recording. If you have any technical questions, please feel free to type those in the chat box as well, and we will do our best to get the appropriate answers. Now on to our webinar. We are pleased to present Budgeting for Young Professionals, Tell Your Money Where to Go. Let's introduce our presenter, Matt Collins. Since 2018, Matt has been helping young professionals build a strong financial foundation for their future. In January 2020, he joined Carl Lutz's team to continue his work with young professionals and assist Carl with his clientele. Matt believes that young people, to no fault of their own, lack knowledge to build their financial foundation, and he strives to provide the education to empower his peers to tell their money where to go instead of asking where it went. Matt is a graduate of the Saunders College of Business at the Rochester Institute of Technology and completed his major in finance. Matt, I'll let you take it away. Thanks so much.
Thank you, Bill, and thank you for the RIT Alumni Office for having me. Today, we're going to go over learning how to tell your money where to go, looking in the windshield rather than out the rearview mirror. So today we want to cover cash flow. Now, cash flow is a few different things. It's looking at how do you spend your money, but then how does your money come in? And all those things happen on different frequencies, and we want to make it easy for you. So Bill gave a little backstory about me. I was able to join Carl Lutz's team in January. Very fortunate to start a new job pre-pandemic and have really found a niche working with young professionals from RIT. It's really nice working with other RIT professionals, being in the Tiger family. Throughout this entire presentation, if you have any questions, whether it's related to the slide I'm on or something else, feel free to put it in the questions or chat box, and I'll answer them as they come up, or Bill will ask me questions. One thing I've really found throughout my time at Lutz & Associates is young professionals aren't taught how to look at their money, how to budget, how to plan ahead in college. It's an area that everyone should look at, whether you're engineering, business, liberal arts. It's an area that everyone needs to master. And it can be difficult, but we found that with cash flow mapping, it can really make life easy. So we found happiness is a positive cash flow for many reasons. And we're not saying that money buys you happiness, but look at not having a job and having expenses. Are you going to be happy? You're most likely going to be stressed, worrying about where the money's coming from. So we want to look at how can we make it a positive cash flow no matter what your income level is, if you have income. And then look at your expenses, whether they're quarterly, monthly, annually. Well, how do you plan for those? So we really want to take a deeper dive. For this workshop, we're going to demystify the complexity of cash flow. We're going to make it simple to understand. We're going to increase your understanding and your also ability to communicate that with your loved ones. And if you own a business, your business. This presentation can apply not only to your personal side, but also if you own a business, you can apply it to your business. Both go hand in hand where they flow in with one another. At the end, we'll provide you with a workbook to get started on your own. You can email me. My email will be provided at the end, and I'll be more than happy to send you a workbook. And if you need further assistance, I'm here for that as well. But we'll walk through the workbook today so that you're able to go do this on your own. So most budgeting tools like Mint, they look backwards. And when you're driving, you look forwards. So that's what we want to do with our cash flow. It's nice to look backwards to see where you've went to plan for the future, but you don't want to always live by looking backwards. Cash flow mapping allows you to see, hey, what's available to spend? What am I spending? Could I be doing a little bit better in some areas, saving money in some spots? And then really, it makes you think about your cash flow. Some of these subscriptions you just are subscribed to, and you might not necessarily know it's coming out. Some might be annual, and you're like, oh, that hit, cool. Some might be monthly. Some might be twice a month. And you're just like, oh, well, it goes out. It's hard to really understand what's going in and out when they're all coming in at different time spots and going out at different time spots. So for us, we found that current problem is really commingling fixed and variable expenses. They're two very different types of expenses. Fixed expense, we label that as predictable in nature. It's going to happen, whether it's every month, every quarter, every year. That's subscriptions, car payments, mortgage, if you own a house, rent. Then you look at utilities. And it might not be the same amount every month like utilities, but that's where we look at a 12-month period or even a 3 or 6 month period. And be like, hey, what's the average? What should we plan for as an average? And then you look at your pay. I know RIT gets paid every 2 weeks. I get paid twice a month. Other people get paid once a month. And then some people get bonuses. Well, how do you account for those bonuses? Are they just a one-time thing that you plan on using that month? Well, what if you planned to use that bonus over 12 months? And then we look at savings. We look at short-term and long-term savings. You might be looking at the new PS5, the new Xbox, and be like, hey, I want to buy that. Christmas is coming up. Other holidays are coming up. And be like, hey, how can I find the money to spend for these gifts? That's what we call short-term savings. You know you're going to spend it within a year. Wouldn't it be a lot easier to save for the holidays and put $50 away every month to spend $600 in December rather than trying to find $600 in December? That's really where we're going with cash flow mapping, is to see, hey, how can we plan ahead throughout the entire year so we can find our average numbers, how we can make sure we have the money when it comes, and so it's there available to you, giving you options rather than you scrambling, trying to find on your own. It's really hard living in a paperless society. Generations ago, our grandparents used to put money into envelopes, and that's how they saved, with cash. Now, we don't do that. We have it all mingled into one or two bank accounts. I've worked with a lot of young professionals that have one bank account, their savings account. Their fixed expenses come out of that, their variable expenses come out of that, and they have that for savings. And I ask them, well, how do you know how much you have in savings? How do you know what your expenses are every month? Do you track that? And 99% of the time, the answer is, I don't know. It kind of just flows. Well, my question then is, how do you pay yourself first? How do you save? How do you look at retirement? If you're in 20s or 30s, you might not be looking at retirement. You might be like, oh, that's a later issue. But the earlier you start, the more your money compounds and the more it can grow. Our goal is to analyze the cash flow, free up cash flow if possible, to ultimately have you achieve your short and long-term goals that you desire. Then there's also too many options to pay your bills. Like, do you have it on auto pay and forget about it? I had a client once that was $15,000 in credit card debt. Just had an auto pay on one of the credit cards. Didn't physically possess the credit card. Completely forgot about the account. Now, that wouldn't have happened generations ago with putting money into the envelopes. So why is it happening now? It's because there are too many ways to pay for things to keep track. It's overcomplicated now. And cash flow mapping is a system where it decomplicates it, where it gives you the power to really take control of your money. And then lastly, income tax. Something nobody likes to talk about, something that nobody likes to pay. It can be confusing. Is it going up in the future? If you live in New York State, you might realize that Governor Cuomo said New York State income tax is going up next year if relief money doesn't come. Well, how does that affect your paycheck? Cash flow mapping helps with that. Looking at, hey, what is my tax rate going to look like? Now, we look at it in one area where it's like, you look at your pay stub, you look at your withholdings. Well, that's how much you're getting a month. But then when you go and file your taxes, you might get a refund. If you're younger, typically you get refunds. And then when you're families, you also get different tax credits. And so we look at that refund not as a one-time bonus, just like an annual bonus would be, but hey, what if you had that throughout the years? What if you had that to spend throughout the months? And so we look at properly adjusting and looking at, hey, are you over or under withholding? Are there ways to fix that? And how can you plan for that with cash flow mapping? This is what we call a circle of confusion. There are so many different areas in here that this covers most of it, but there are more. Each individual has different concerns as well. And cash flow mapping hopes to address those concerns and make you feel confident about your money. So what is the solution? Talked a lot about the problems. So first solution is to convert all of your income and expenses to a monthly number. You need a common denominator. You need to be able to say, hey, this Amazon subscription I pay $120 a year for, that's $10 a month. I know it comes out in, say, December, but we're going to save January through December for it. You also want to pay yourself first. We have found that 20% of your gross income to long-term savings is ideal. Long-term savings, that's a little subjective. That's mainly meant for an emergency fund or retirement, really buying a house, buying a car years down the road. Something to achieve your goal that you want to save for the long term, not this year. Something like saving for gifts for people, going on vacation. That's more short-term savings. And we want to look at that too. So we want to look at, hey, how can you pay yourself first? Or what I do with a lot of young professionals is I analyze their fixed and variable expenses with them. I look at savings last. Not because it's least important, but because I know a lot of young professionals might not have a lot of cash flow to work with. They have those fixed expenses that can't be moved. Then you have your variable spending. Variable spending is what you desire to spend and what you can spend. If you make $150,000, your variable spending is going to be a lot higher than somebody that makes $50,000. We look at what you desire to spend, and then what can you afford to spend? Then back into a savings number and be like, hey, is this what you want to save? If the answer is no, how can we adjust variable or fixed expenses to get to the number you desire to save? A lot of this is going to be what you desire. Anybody can have suggestions for you, but in the end, it's your cash flow and it belongs to you. Then we look at separating your fixed and variable expenses. They're hard to commingle. If you look at this picture on the right, it has long-term savings, variable spending, and fixed expenses. We think of those as 3 different buckets that your money's coming out of. How can you demystify that? How can you make it the simplest you can? Well, we look at having one savings account. Then we look at having 2 other accounts. One's the fixed expense, one's variable expense. Your pay stub comes in, you pay yourself first, and then you go and put money into your fixed expense portion, and you put money into your variable expense portion. Now, variable expenses, there's a few different components there. You can allocate spending. Be like, hey, I'm going to spend $400 on groceries, $300 on dining out. Oh, I want to go spend another $300 on entertainment. Start adding all that up, your hair, your nails, all that stuff. And then you get to your allocated spending number. Well, then what about travel? That's variable spending. It might go up or down in a year. I'm sure during this time, a lot of you are not traveling much. And so your travel budget might go somewhere else this year. But then we look at saving to spend. We keep those 2 different. Sometimes what clients do is they have a 4th account. That's the save to spend account. So they have 2 savings accounts, the long-term and the short-term savings. Then they have variable spending and fixed expenses. At the beginning of every month, they have enough in their savings. They transfer their variable spending number over. They're allocated and then they're saved to spend in the 2 different accounts. And they put their fixed expense in there. Now, you might be thinking, okay, so then my fixed expense is going to go down to 0. It might not. If you own a house and your water bill's quarterly, then your fixed expenses are not going to go down to 0 because some stuff is going to hit every 3 months. Some stuff is going to hit every year. But you know by keeping it in that account, it's paid for. That Amazon subscription you pay $10 a month for, you're putting $10 a month into that fixed expense account. Then you're able to pay for that on a monthly basis rather than finding it. That variable spending account, we recommend doing all your grocery shopping, all your variable spending on a credit card. It's safe, it's secure, it gets you points back. So then you go swipe that card throughout the month, actively looking at the balance. Personally, I use the Amazon Prime card. I practice what I preach, and I set myself a low budget, I call it, of allocated spending a month. I go, I spend up to that much each month on my credit card, but I have that much in my variable spending account to be able to pay it off at the end of the month, so I'm not carrying a balance. I have the Chase app on my phone. I go in, I look at my credit card every week. Hey, am I on track? That's where you're able to look behind you. Make sure you're following along week to week. But by using cash flow mapping, you're able to look forward too and be like, hey, this is what I desire to spend. How am I doing with that? You're combining looking forward and looking behind you as you do when you're driving. So then paying off every month gives you nice satisfaction. You're not carrying a balance. But what happens if you go over 1 month? Is that okay? During the holidays, you're probably going to go over than in January. A lot of people cut their spending in January because they spend a lot in December. That's okay. Variable spending is just that. It's variable. It goes up and it goes down. You want to put an average there for allocated spending. So then some months you're not going to get to that budget limit. You're going to get below that. You're going to keep money in that account. So then once you go over that, you have the money available to spend. All this does is solve to see what's available to spending. It looks at your pay stub to see what taxes are withheld and what comes from that, what your deductions are. And then it gives you a system to manage it all together. You're able to look and be like, hey, I'm on track. I know what I'm doing. I feel confident in this and I understand it. And that's what it's meant for, is to give you that understanding. Now, we turn this complex circle of confusion that a lot of people struggle with. A lot of people end up in credit card debt. I don't know if you've seen some of the numbers, but the average American is over $10,000 in credit card debt per household. It's a lot of money. I was meeting with a couple that was making $250,000 a year in credit card debt. It can happen to anyone. Oftentimes, the more money you make, the more confused you are where it goes. This system is in place to help you really take charge and do it yourself. We'll review workbooks here in a few minutes where this breaks it all down, where you're able to do pen and paper and be like, hey, this is what I want to do. This is my plan. And no plan is static. In the society that we live in today, things change by the minute. In February, everybody was going out. Everybody thought it was just a normal world. March hit. I was supposed to attend a gala that I was planning for the American Foundation for Suicide Prevention. Every day, things kept changing. And then one day, it got put off. Plans are supposed to change, and that's okay. These numbers are not set in stone, and they're not supposed to be hard stop numbers, but they're supposed to give you confidence and direction to an area that often is not taught. So to implement this, we often recommend nicknaming the accounts. Now, what might be a good nickname? I use fixed expense for my fixed expense account. I use variable spending for my variable spending. I name them just what they are because that's what makes sense to me. But oftentimes, different things make sense to different people. We all learn different. So nickname them what you want. The important thing is creating the accounts and then sticking to the plan. And then what I recommend, if you're in a position to do so, is having your pay stub go directly to the long-term savings. You're practicing what you preach and paying yourself first. And then at the first of every month, move over the variable spending, move over the fixed expense, and move over the save to spend. Or if you have to do it the first of the month and the 15th of the month, figure out a system that works for you. I work with a lot of professionals that sometimes don't have savings. And so we look at, hey, how much of your paycheck has to go into each account? So that makes sure that your bills are paid on time, but also you're paying yourself first. That's the big thing. Like, it's great if you have enough in your savings account to move that over to variable and fixed expenses every month. People aren't in that position, and that's okay. People that aren't in their position want to take charge of their cash flow. And I empower you to do that. You got to start somewhere. And starting somewhere is better than not starting at all. And then, as we mentioned, you want to save for those monthly bigger expenses. Save. Hey, I want to go buy a drone in May, let's say. How much do I need to save each month to do that? Let's break that down. And then it's like putting that cash in the envelope. You're able to go pay in full. Great. You still might be able to get financing for it. Use that financing in your favor, though. If you get 0% financing, it might be smart to use that and let your money grow in the area. I'm not going to say as a blanket statement that you should do that. It depends on the person, where you might feel comfortable doing it, and you might have enough confidence in your cash flow that you know you're not going to go further into debt in order through financing that. But that's where we look at, hey, once we start getting confident in our cash flow, how can we then move our cash flow around a little bit and make it work for us? And if you're a family, we recommend using one credit card. You can have multiple signers on a credit card. Credit cards are most secure. Having a debit card, it leads to a lot of vulnerability that we don't want to have. And then by having one credit card, you're able to easily track your variable expenses. Then your fixed expenses out of one bank account, you're able to easily track that. For people that just have one savings account, everything comes out of that. It's very hard to decipher which one's fixed, which one's variable, which one can you cut back on if you need to increase cash flow. How do you increase cash flow? All of these are areas that our firm looks at to make sure, hey, are people properly allocating their cash flow to maximize their own potential? And also by using a credit card, you get rewards. I get 5% cash back on my Amazon purchases, like 2% at the grocery store and gas. Like that adds up after a while. If you're putting all of your variable expenses on there and say it's $3,000 per month, go get 1 or 2% cash back on that. That's money that you didn't have to do anything to get. You're already spending that money. Whether you use it on a debit card or a credit card, the money's being spent. So spend it wisely. But make sure you're paying off the credit card each month. Credit cards can have high interest rates. If you have a debit card and you don't have the money in the account, then you're not buying something. Think of it the same way. So Pierce just asked, I've heard that more than one credit card benefits your credit score. Is this true? The answer is more complicated than yes or no. I'm no expert in credit scores, but I do have a lot of experience with them. That the more credit you have available to you and that you have in your name and the least amount use of that. So say you have $20,000 and you're only using $1,000 of that, your credit score will be a lot better than if you're using $19,000 of your $20,000. So it's all a ratio. So if you're using 5% of your credit available, then it is better than if you're using 50%. But if you're paying it off in full every month, then you're able to look at your credit score when you pay it off and look at it then rather than right beforehand. It'll be better. You can have multiple credit cards. I'm working with a couple now that's paying off $21,000 of credit card debt. My advice to them is not to close a single card. Instead, cut up the credit card, have the usage of that credit limit go down to increase your credit score. I always go for the max amount limits, not because I need it, but because it only helps my credit score. But the thing is, if you're not going to use that credit card and you're concerned about overspending on it, cut it up. Have it out of sight, out of mind, but still have it open. It gets tricky where people are like, hey, I have the credit card. I overspent last month. I overspent this month. Are they going to keep overspending? What happens if they do? Then they might go in debt. That's where you want to curb it a little bit and be like, hey, what are ways that we can minimize your chances of going in debt through habits? So yeah, having more than one credit card benefits you, but don't apply for them all in the same year. Having a hard credit check hurts your credit. So the more hard credit checks you have, the lower your credit score will be. You want to let those go off your credit report before you keep applying for more ones. I hope that helps, Pierce. So going through all this, let's review the workbook. And to get this workbook, again, just email me. We'll have my email at the end of the slides, and these will be available to you. And I'll just send it off via email, and you'll be able to do everything on your own. Let me pull up these. So this is just a 10-page document. So the first page, it looks at your net income. Now, this is meant for a couple. So if you are single, you can just do pay stub 1. If you do have a second income source, then there is a second pay stub option. You put down where that's coming from, nickname it. Hey, I work at Xerox. It's my Xerox income. What do you get paid? Well, I get paid monthly. So then you put down your gross amount on that. There's 2 different amounts. There's your gross amount and there's your net amount. The net amount is how much you get in your pay stub into your bank account. The gross amount is how much you have to report. So I got paid $5,000 a month from Xerox. So then put in 5,000 there. Put in pay frequency of 12 because it's 12 per year. And then it gives you the annual amount. Then you divide it by 12 to get a monthly amount. That's easy because the monthly amount was 5,000. But then if it's every other week and you got paid 3,000 every other week, 3,000 times 26 equals your annual amount divided by 12. And then you go through and you're like, hey, what are the deductions? You're going to have taxes withheld. They're a little annoying. Everyone has to pay them. Well, let's account for that. And then let's look at, hey, are you doing group life insurance? Are you doing group disability insurance? Sometimes disability insurance gets confusing. I know if you work at Rochester Regional Health, they pay you the amount that's deducted from your disability insurance. So say it's $2 a paycheck, they'll include $2 in your pay. So you have to be careful for that gross amount. But then that $2 comes out right here. And that's important because with disability insurance, if you pay for it, it's a tax-free benefit. Then we look at health insurance too. Hey, is it a family plan? Are you single? And dental, vision. Does it make sense to put money in the HSA? All of this matters right here because they're all considered pre-tax deductions. So then they can take money, it comes off of your taxable income and then reduces your taxable income. Does that make sense? And then we'll get to putting money in your 401k in a couple of slides. That's another deduction, whether it's a 401k or a 403b. I know RIT has a great 403b plan, but then you look at, hey, is it going to the Roth 403b? Is it going to the traditional 403b? What are the differences? Well, that's where it gets a little bit more complicated. And if you ever want to review your plan, look at all that stuff, go way more in depth. I'm available for one-on-one consultations where we can look at, hey, does it make sense to have a Roth IRA? Does it make sense to do the traditional? What are the benefits of each? It's all about you becoming educated so that you can make your own financial decisions and have the confidence behind that you know that you're making the right ones. Looking at all these deductions, you'll deduct all of it, add it together, deduct it from your gross pay to get your net amount. Now, same thing for pay stub 2. And then you go in, what are we contributing to long-term savings? Looking at contributions from your pay stub. Hey, are you contributing to your 403b, 401k? Do you have a deferred comp? Is there a simple IRA? 457b? How does all that work in the future? Is it invested properly? All that stuff, it gets complicated. One thing we want to be is like, hey, what's your match to? It's not on here, but an important thing to know is what your match is. You never want to go below your match for your 401k, 403b. It's important because it's free money. If you contribute 5% of your income at RIT, you get a 9% match. It's amazing. If you contribute 4%, it goes down. So you always want to make sure you're contributing the most amount possible. That gets you the match. But then anything over the match, look at, hey, does it make sense to put that in a 401k which you can't access to your 59.5? doesn't make sense to put into a savings account if you're low on short-term savings or long-term savings there. What all makes sense there? And then we look at, what are you contributing to other assets? As I said, if you're contributing to your 401k above the match, maybe it makes sense to put money into a money market account or your bank account if you're not saving. We look at, how do you diversify yourself? You should have some savings from your pay stub if you have those plans available to you. And then contribution to other assets as well. You want to grow your savings account to an area that you're comfortable with. Maybe you also want to play with some stocks. Do you want to invest in real estate? Do you like life insurance? Now, you'll see life insurance here because these are assets. Whole life insurance is an asset, serves a dual purpose, grows cash value, and it is life insurance. So if you die, there's a death benefit. So as a contribution to an asset rather than a fixed expense, which you'll see on the next page, there are fixed expenses that you can contribute to. So here, you go add up your pay stub contributions and your other contributions, and that's what your total long-term savings is. And then you look at that and be like, hey, how much is that of my monthly gross income? Are you at 5, 10, 15, 20%? What do you want to be at? We have people that save 35% of their income. And I'm like, that's amazing. And they're like, well, what should I do? My go-to answer is 20%. It's a really solid number. Anything over 20%, go do what you want with it. People want to spend on variable expenses. Great, go do that. People want to save it. Great, go do that. We have people making $150,000 a year, and their annual expense or their monthly expenses, my bad, are $3,500. Super low. And I'm like, what do you want to do with the rest of the money? And they're like, save it. I want to keep saving money. I want to retire early. Great. How can we accomplish that? All of this with savings is how to accomplish your goals. We don't spend money for 40 years and save money for 40 years while working to then just retire. We have goals along the way, and we have goals in retirement. We don't just retire at 65. Some people want to retire at 55. Some people want to work until they're 75, 80. This is about how you can accomplish your goals and take charge of your cash flow. So then here, fixed expenses. Fill out all your fixed expenses, your rent, mortgage. Break out your mortgage. If it's escrowed, get the mortgage statement, break it out. What are your property taxes a month? What's your homeowner's insurance? What's your PMI? If you have PMI, some people don't because they have 20% equity in the house. Also, right now it's a great time to refinance if you have good credit. Interest rates are low. You can look at this, go do a map now, and then do another cash flow map. Hey, if I refinance, what does cash flow look like? Excuse me. So we go through, and then we look at monthly insurance costs. Medical and dental might be on the pay stub. So some of this stuff might be on the pay stub, and might be here, but you only want to account for it once. Sometimes medical and dental can be accounted for twice. Just make sure you're accounting for once. Yes, Christine, I'll be sharing my email at the end, and then you can email me and I'll send you a workbook. So you go look at your other expenses as well. Cell phone, student loans. One thing I also like to look at is how do you look at other people's expenses that are, like, your parents might be paying for your cell phone if you're younger. How do you look at that, and how do you plan for you to pay for that in the future? I never want to ignore those expenses. People sometimes ignore those expenses. My parents pay for my student loans. My parents pay for my cell phone. Whatever it might be. Plan for you to pay for it eventually. On our online version of this, which you get access to if you worked one-on-one with me, we have a section that goes in depth about debt. A common question is, how can I pay down my student loans fast? Well, how can we pay down the student loans fast and accomplish your goals is my question. What years are your student loans being paid off? What's your goal with that? And what's the number you need to put towards that to accomplish that? That's an area that I work with a lot of young professionals on to accomplish their debt goals. If you graduated from RIT recently, you more than likely have student loan debt. And that's okay. Debt is not bad. That's a tool that must be used wisely. And so some of these are debts, and you might look at how do I accelerate debt payment? But then I ask you, make sure you're paying yourself first if you do. Then lastly, it gives you a variable spending amount that's available. Now, you might put 10% of your long-term savings as your first base map, and you might have a high variable spending amount available. And you're like, that's not right. Well, you might be putting money into savings that you didn't account for. So I would encourage you to look at spending available and then go on and allocate that spending, allocate that save to spend, and be like, hey, what do I want to spend? What's reasonable? Then you'll have an unallocated spending number. If it's a large enough number, go put some back into savings. Pay yourself first, test it up. Always have a buffer though. Never have this number be zero. I always like about $100, $150 a month buffer. You never know what expenses you might not have accounted for. After you test it out for a few months, you could go look, review your variable expenses because you have it all on that credit card. Go review your fixed expenses. Make sure you accounted for everything. And then update this. At first, you might be updating this every 3 to 6 months. And after that, you might just be updating it when you want to accomplish new goals. Elizabeth, just saw your question. Sorry for going back to retirement funds. Do you have a general rule / recommendation for if you are offered a 401k versus traditional Roth, 401k traditional versus Roth? So I'm going to speak for myself. I'm younger. I graduated college within the past year. And so I know for me, I have 40 plus years ahead of me for working. I look at, hey, what are taxes going to look like? When we're going back to long-term savings from pay stub, there's 401k Roth, 403b Roth, and then there's also a Roth IRA. Roth IRA you're not eligible for if you make over $129,000. But I always recommend people go for the Roth because I'd rather dance with the devil I know than the devil I don't know. We're at historical lows for tax rates right now. Tax deferred or traditional 401ks were great when the highest tax bracket was at 72%. They deferred taxes and now are paying 35, 40% maybe. That's a significant savings. But if you're paying a low amount now and taxes go up in the future, then you're going to be paying a higher amount if you defer the taxes. So I'd always recommend paying the taxes now. That's just a general statement about me. I do a Roth 401k. Elizabeth, I strongly encourage you, if you want, we can look at your situation and see, hey, does it make sense to do a traditional 401k? Because if you want to defer taxes because you want to get your income below a certain point in order to be eligible for things, then that might be smart. Like any investment advice is generic. I'm always going to say what I do because everybody's different. Everybody has their own situation. And I know people that pay for their own medical expenses and medical plans don't get it offered through work, so they keep their income low. They put a lot of money into a 401k traditional because that brings down their taxable income and it keeps their insurance low. So there's many different variables, but I personally put money into a 401k Roth. So very good question, Elizabeth. It's 401k Roth. It's actually something new as well, and not many places have offered it. And so it's just starting to become more and more popular, and it's an option that I love. So then after allocating it and you go and get your unallocated spending, keep looking at this every few months. If you're going to make a big purchase, buy a house. Look at, hey, what does that mortgage look like? Map out your cash flow. It's a dynamic plan. And then you'll be able to get this report, fill in these numbers, see what this is like, and then keep your base map, as we call it, and see, hey, how does my base map compare to buying a house? All of these are different ways that you can plan for the future and look forward based on where you've gone in the past. We change and we grow based on our past experiences. So it should be the same with money. We should learn from our past experiences and then easily change and compare it. And this allows you to do that. So you'll have access to this, and then also you'll have access to the worksheet instructions, which goes through everything. Just has introduction, it goes through everything. I'm not going to go through it all with you. That's what I verbally did. And so you'll be able to access the instructions on your own, and then you'll have the workbook to actually do it as many times as you want. The only stipulation is if you want online access, we do have a web portal online that you can do that. We require you to work with an advisor if you do that. Many advisors across the country are using cash flow mapping. I'll share my information at the end of this. If you want to work with me, I'm more than happy to work with young professionals. An area that I work with young professionals a lot is cash flow analysis and management. We look at, hey, what do you want to do? What are your goals? And then I work with a senior advisor. His name's Carl Lutz. He's been in the business for 22 years. He started when he didn't want to be in the restaurant industry anymore and want to spend more time with his family. And so main areas that we focus on together is wealth protection, investment analysts and management, and retirement income planning. Now, retirement income planning is a broad topic. You could look at a 25-year-old to look at retirement income planning of how to accumulate assets, how to build your net worth. And then as you get closer to retirement, it's how do you have your net worth make you income? And then Carl really specializes in estate planning, business succession planning, and business exit planning. All of that really is retirement income planning as well. How do you make sure that your loved ones are taken care of? And then an area that we look at together is charitable planning. Do you have a desire to leave a legacy? What's the best way to do that? All of these are questions that it's hard to answer. And it's hard to be like, hey, what's a general question that you have? And then how can you apply that? Like, they're all general answers you'll get, and everybody's plan is different. And so these are areas that we can specifically help you with. So at the end of this, reach out to me. Here's my information. If you want a workbook, please feel free to email me. I'll email you a workbook. No obligation, no commitment. You'll just get that one email. If you want to hear from me again, great. It's easier than having Bill send out all the emails, just because this is going to be replayed in the future. If you want more help mapping out your cash flow, looking at your situation, and also free consultation, just text me your name, email me. We can set something up, look more in depth. You can have specific questions. Be like, hey, this is my situation. How can I do better? Any last minute questions?
Yeah, if you want to put your, thanks so much, Matt. If you want to put your questions there in the chat box, I had a few pop in my mind, Matt, as you were presenting. I know myself, I use Excel to kind of analyze cash flow, but I was wondering if you had any like good recommendations on like some either free or inexpensive software or resources that people can use for budgeting.
So looking backwards is I like Mint looking backwards. Looking forwards, I found that aside from cash flow mapping, there's not really a tool that looks forward, looks through the windshield. Excel does a decent job, Excel gets confusing. For people that aren't super familiar with Excel, it can be super overwhelming. I love Excel myself. And so I didn't get overwhelmed with it. And working with an advisor doesn't necessarily mean you're being charged a fee either. And so if you're working with an advisor that doesn't charge you a fee, you can get cash flow mapping for free.
Awesome. And I know you mentioned this, that everyone's situation is different. But if you had if you yourself had an employer sponsored retirement, benefit, and you wanted to take one step to supplement that somehow, for retirement, what's the first option you would look at or pursue?
So an area that I look at a lot is whole life insurance, because it's an area that not many people know about. When you have a family, the first thing is, hey, I need life insurance. Why? To supplement income in case you die. Great, you're paying for an expense. Whole life insurance is an asset. It grows in tax-free cash value. It acts as a fixed income portion. It's not correlated to the market. So then your 401k could be a lot more aggressive, having the opportunity to get better returns. The older you get, the more conservative you have to be in order to preserve your capital. If you have a fixed income portion, whether it's bonds, whole life, other assets that are not correlated to the market, then you're able to be more aggressive in your 401k. And so I look at whole life insurance even for younger people because it's cheaper when you're younger. And rule of compounding, you grow more when you start earlier. And so I like that because it's tax-free as well. I work with a lot of people that their income varies too. If your income's over $129,000-ish, you're not eligible for a Roth IRA. And so I don't want somebody at $125,000 contributing to a Roth IRA that then is going to become ineligible after a few raises. I like dynamic plans that could grow with people.
If you're married filing jointly, what that limit goes up a little bit, right?
It goes up to like $201,000. So it's not that big of a jump.
Right. Say if you're just out of college and you work with an employer who doesn't have, the benefit of an employer sponsor, retirement program, and you were in that, like you said, everyone's different, but if you were in their shoes, what's like the step one, what's the one thing they should do to, going down the path toward, for planning for retirement?
The first thing I'd actually recommend is not looking at retirement. Looking at your short-term and long-term savings. I have people contributing to a 401k or traditional IRA, which you can't touch till you're 59 and a half. So if you're contributing to a traditional IRA, then can't touch that and don't have the savings. And then they go in debt because they put their expenses on credit cards. So my recommendation would be build up your savings, have 3 to 6 months worth of expenses in your savings account available. Then look at a retirement fund. If you're under the thresholds, look at a Roth IRA, look at whole life, look at a traditional IRA if you're looking to defer taxes, if that makes sense. Work with a professional, build out a plan that fits you.
We did have another question coming from Christine. She asks, any recommendations for savings accounts that yield, the best interest rates, currently using Capital One 360?
Interest rates in savings accounts are never going to be great. It's 6 one, half dozen another. I typically just go with whatever's convenient for me. I like all my accounts under one roof. I go with ESL, and so I just go with the best one that they offer.
We'll give it another 10 seconds if you want to enter another question in here for Matt.
I really appreciate everyone tuning in.
Oh, here we go. Question from Evan Coyne. Hi, Evan. Do many of the brick and mortar banks, like Bank of America, allow you to have multiple savings accounts in order to save for different funds?
Yeah, so I use ESL, and so I go in, I have 2 savings accounts and 1 checking account right now with them. And I'm able to open up as many savings accounts as I want.
We do the same thing from my experience. We're with ESL too. And we have a checking account, one for, our fixed amounts that, goes in every paycheck, and it works well.
Yeah.
Yeah. I think another one came in. I heard a pop here.
That was everything. Thank you.
Oh, okay, cool.
I've always been taught practice what you preach, and I've started this from day one, and it's really helped me as a young professional stay on track, stay on top of my student loans, stay on top of my own savings. Because if you're off to a rocky start in the beginning, it's hard to get out of a hole, and it's easier to have the momentum to then keep growing off that.
Awesome. Well, thank you so much, Matt. And like Matt said, we'll share his info again in a follow-up email. Anna on the back end also included his email there in the chat. So feel free to reach out to Matt with any questions. But I'd like to thank you all for joining us today for this great presentation. Additional questions can be emailed to ritalum@rit.edu, or you can direct your questions to our presenter. All audience members will receive an email from us in about a week with a link to today's webinar recording. You can view a full listing of upcoming virtual events at rit.edu/alumni/events. We have several more planned this month, and we'd like to include you in as many of these events as possible. Please exit this webinar by simply closing your browser window, and please do let us know what you thought of the webinar through a brief survey that you will receive via email. Thank you, everyone. Have a wonderful week and enjoy the holiday season. Thanks again, Matt.
Thank you, Bill.